Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. There is a lot going on here within a fairly narrow piece of action. Not in market price movement, but in a narrow piece of market angle of attack. To explain, 5 weeks ago, I highlighted the action since August as a descending expanding wedge pattern, currently 574 to 675, and is highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but as I said 3 weeks ago, and I quote, it does hold merit, and I would look to this pattern for some immediate idea of the move downwards. Well, it does still hold merit, but I also saw development of two new patterns, one of which involves the descending expanding wedge pattern. So, if we utilize the lower trend line of this pattern, currently at 574, highlighted in blue, and then the new upper trend line in green, currently at 631, we have a bear channel within the original descending expanding wedge pattern. Then again, if we look purely at the new upper and lower green trend lines of this on their own, they're currently 605 to 631, we have a descending wedge pattern, once again within the original descending expanding wedge pattern. I hope I've been able to explain what was and is, to my mind, and on my mind, and also the three main patterns, currently bearish patterns, that have been driving this market. So what do we have in the way below that could obstruct further declines here? Well, there has been only one level that I said might, and after a fashion, has supported the market, apart from the trend lines, of course, and that is the 38.2% Fibonacci line of the big 2011 to 2019 move at 618. Though it has not acted as a brick wall, but more like a trampoline, and falls in line with the doubts expressed about it 2 weeks ago. Beyond that, there is the July 2021 low at 578, and perhaps the more formidable March 2021 low at 559. However, this week has been an interesting week, as we saw a false break lower out of the descending wedge pattern, followed by a strong reactionary move back up, such that yesterday prices broke above the upper trend line of the descending wedge pattern. This is not a false break higher, not yet, but neither is it confirmed as a move higher. But I would like to point out one feature of this week's action. We are set today to make a weekly key reversal. Thus, if we close tonight either over 628 or under 611, then we'd be on. Anything in between would make the lesser outside weak pattern. At the moment, we are looking at a weekly key reversal up, a possible weekly key reversal up, but it is close. Minneapolis wheat. Now, compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in recent times, with respect to what was going on and what the opportunities might be. Though this is no longer necessarily true, this market still has its moments. So, in late February, and especially at the start of April, so that is just within my daily chart, the market constructed a large bear channel that morphed into what we see highlighted in dark blue on my daily chart, a descending expanding wedge pattern, currently 597 to 802. This pattern actually originated from December last year, but really became evident, as I said earlier, from February this year. The upper trend line has been escorted and reinforced, well, sort of, by the declining medium moving average, currently 785, which, when combined together, helped cap the market back in very early April, then mid-April, mid-May, and mid to late June. However, in mid-July, the attempts higher resulted in a clear break above the upper trend line, and also above the important declining long moving average, currently at 815. Prices back then climbed rapidly up to the 50% Fibonacci line of the significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that has captured my attention, as the market had, since late July till mid-September, formed a descending scallop pattern. Not only that, but since mid-September we have seen the market form the crucial ski bump of this descending scallop pattern, and since the beginning of October start its further journey lower to potential targets for such a pattern. Thus, the primary target was in the 6708 zone, with our secondary harder to reach target X1 in the 689 zone. This week prices reached down to the primary target, but reverted back up almost immediately. Looking back for a while to the early to mid-October action, back then the market made a valiant attempt to turn back up, but the May low at 769 capped the rise and turned prices back down into a band of supports starting at the August 2017 high at 754, then at 744, then the important June 2021 low at 737. That is the gateway to a band of congestion between 737 to 724. All these were tested, but eventually failed, and are now resistances along with, and I suppose guided by, to some extent, the declining short-medium moving average in green. I would now like to highlight a more recent pattern, one that I spotted 6 weeks ago. It is the somewhat nascent late August to date bear channel, highlighted in bright red on my daily chart, currently 674 to 766. We've not seen the market test either bear channel line since late September, so I'm ever so slightly suspect about it, but it still exists as a pattern. So that is the current situation, but I would like to point out one interesting feature, as how we currently have a smaller bear pattern nested within a larger bear pattern, much like a Russian doll.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.